On Independence Day this year, Prime Minister Narendra Modi announced important changes to the GST, or the Goods and Services Tax structure. This is good news for consumers, but questions remained around whether this would impact other economic health parameters. Is it all good news, or should we expect some short-term pain? Hello and welcome back to Business Matters at The Hindu with me, K. Bharat Kumar. Upcoming changes to the GST structure would mean that there would be fewer tax slabs and hopefully easier compliance rules. And this has been the demand from Indian industry for quite a while, that there are too many tax slabs and GST was meant to simplify compliance. Here's a bit of background. The previous NDA government brought in the GST regime in 2017 for the first time in India under the theme of One Nation, One Market. This was seen as the biggest tax reform since independence. But the regime had 4 tax slabs at 5%, 12%, 18% and 28%. Some items such as cigarettes and luxury cars attracted a further levy. What was supposed to be a simplified tax structure turned out to be cumbersome on the ground too. A popular example of differential tax rates being applied on similar items is that of popcorn. Pre-packaged salted popcorn came at a GST rate of 12%, whereas caramel popcorn was taxed at 18%. Likewise, rotis would be taxed at 5%, but parathas came in at 18%. Industry watchers are hopeful that after 2.0 of the GST regime will help iron out these wrinkles, as also others such as the inverted duty structure, where one pays a higher GST rate for raw materials than for the finished product. But the good news, as we all know by now, is that these changes will help spur consumption expenditure, and some analysts expect that this spike in consumption will more than make up for the revenue lost to the government because of lower tax rates. A downward tax slab change for many items such as cars, consumer durables and electronics is expected to boost consumption by Rs 1.98 lakh crore, according to an analysis by SBI Research, which Business Line has quoted. When taken together with the recently announced income tax slab changes, the combined impact of both measures amounts to an additional Rs 5.31 lakh crore of consumption expenditure in the economy. This translates into approximately 1.6% of GDP, according to the report. SBI Research estimates that because of these changes, there could be an impact in terms of revenue loss of about Rs 85,000 crore annually on average to the government. And in this year, because we're already 5 months into the financial year, the impact would be to the tune of Rs 45,000 crore. But the agency estimates that because of the higher consumption kicking in because of these changes, the tax collections by the government would not be significantly impacted, and hence there would be little impact on the fiscal deficit. In fact, SBI Research estimates that in the best case scenario, there would be additional GST revenue to the government. The agency says that at an estimated consumption boost of 5.5 lakh crore rupees, with an effective tax rate applied at 9.5%, the additional GST revenue to the government exchequer comes to about Rs 52,000 crore. Others are not so optimistic. In a note titled, "Does the government have enough money?" Macquarie Research says, "We are not sure where there is room for the government to give more benefits to the consumer unless fiscal deficit is expanded." In recent times, the government has aimed to keep fiscal deficit on a tight leash, and for this year, it is estimated at 4.4%. Interestingly, upcoming changes to the GST structure could mean mildly better or improved inflation rates. Because of lower GST tax rates on mass use items such as food and clothing, inflation could moderate by about 20 to 25 basis points. And the impetus to GDP would be 0.6%. In terms of sectors, the proposed removal of 12% GST rate would be a positive for processed goods, garments above Rs 1,000, footwear, tractors, farm equipment, construction material, and hotels. Goods that are currently taxed at the 28% slab will benefit from going down to the 18% slab, and these would include air conditioners, automobiles, largely two-wheelers and small cars, as well as cement. But there are concerns around the potential slowdown in the sales of some items. Here's why. The final rollout of the new GST regime is expected by Deepavali of this year, which is in the 3rd week of October. First, the group of ministers convened on the rate change is scheduled to meet on August 21st. Based on the GOM's advice, the Fitment Committee puts out an agenda for the GST Council to take up when it meets between September 16th and 19th, at the end of which it would give out its recommendations. If there are no further glitches, the center and states will then notify the changes. Which means buyers could potentially wait till around the Deepavali time frame to make decisions on their purchases. Let's take an example. Assume you're in the market to buy a small car at a price of rupees 5 lakh. If it meant that you wait till Deepavali and pay a lower GST rate of 18% instead of the currently applicable 28%, that could mean savings of rupees 50,000 to you. So if customers across all such categories tend to postpone their purchases, that could have an economic impact in the current quarter. In fact, auto dealers are saying that customers are already seeking information about a reduction in prices. That brings us to the Did You Know section that we have for you in every episode. Did you know that the history of GST goes back as early as the year 1954, when it was adopted by a European nation, followed by more than 160 countries worldwide since? And related to it, here's the quiz question for this week. Which country adopted GST first in 1954? And here's the answer to last week's question. How much did a Labubu toy sell for at the first Labubu auction by a Chinese auctioneer? A Labubu figure sold for more than $170,000 at the first Labubu art auction hosted by the Yongle Auction in China. The event drew nearly 1,000 bidders, the auctioneer said. That's all we have for you folks in this episode. If you enjoyed what you saw, do not forget to like, share and subscribe. Until we meet again, have a wonderful time ahead.